what is a stock? In order to really talk about it, I feel like we need to talk about mutual funds, segregated funds, ETFs, index funds, and some of the different types of shares that are out there, common and preferred. But before we really get into it, if you like the video, you like the content, feel free to hit that like button and subscribe to the channel. I appreciate it. Hey everyone, Kadeem here. And the question, what is a stock? Well, we're not going to go too deep into it today, but this is just a quick overview. All right. So a stock is partial ownership of a company, to keep it simple. All right. Apple, Google, Amazon, these different companies, they're public. So they have shares that are available, stocks that are available for purchase on a stock exchange in the stock market. You buy a certain portion, you buy a certain amount of stocks, you are seen as a partial owner of that company. Depending on how many you own, it gives you a certain amount of voting rights. If you own, for example, 51% of the stocks of a specific company, then you can make those decisions, right? You own 51%. You can make the final say essentially because you have 51% voting right. Now, that's not common for some investor to own 51% of stocks or shares in a company, but just to give you that example. Now that is stocks, right? You can buy them on a trading platform, Wealthsimple, your bank's trading platform, or whichever other trading platform you have access to, you can get them from there. Now you can buy them any time of day, essentially from 9:30 Eastern AM to 4 PM Eastern. You can trade, you can buy, you can sell, you can set limits and all that stuff within that time frame. Again, we're not going to go too far into that, but you can buy them, sell them at any time within that time frame, right? 9:30 AM, 4 PM Eastern Standard Time. Now, in order to buy a stock, a share of a company on a stock exchange, a stock market, it might cost you, there's a range. It might cost you $3,000 plus like Amazon. It might cost you $300 like Microsoft. That they're around $300 right now for Microsoft. Amazon, $3,000, right? I think $3,300 as of the recording of this video. Google's not too far off, $2,800. So as you can see, there's a range, right? $3,300 on Amazon, $300 roughly for Microsoft, and everything in between, there's some lower than that. So depending on which companies you really want to buy and get into on the stock market, you can be looking at a pretty hefty price, $3,300, or you could be looking at $300, right? Maybe a little bit less than that. It all depends on how you want to construct your portfolio. Now there's trading fees every time you trade for a stock, right? You buy a share, you sell a share, there's trading fees you have to pay with most platforms. Now I'm not going to get into that. Moving on to mutual funds. Now, mutual funds is essentially a collection of stocks, a collection of shares, right? And I talked about the pricing for a stock. That's Amazon, $3,300. Now, for a mutual fund, you don't have to pay the $3,300 to get one stock or one share. Now you are investing in a pool because there's many people investing into this mutual fund, and we're buying many companies at the same time. We might be buying Amazon, we might be buying Apple, we might be buying Google all at the same time, Walmart, and so on. And therefore, you can put in $100 a month, $50 a month, however much, depending on the investment company that's managing your mutual fund for you. Now, of course, again, there's fees and all the things that we're going to talk about. But one thing to note, again, is with mutual funds, these are actively or passively managed. And what that means is actively managed, there is a certain fee, of course, higher than the opposite, which is passive, because you have a professional account manager essentially managing this account, this mutual fund, buying and selling stocks to make sure they match the projection of that mutual fund. The prospectus is what it's called. Now, with your mutual fund, you can be invested in stocks, bonds, and different type of securities, right? You can be invested in many different areas in the world. You can be invested in North America, Canada, US. You can be invested in South America, Asia, Europe, different places, all with that one mutual fund. So that's one of the big benefits to it, is because you have access to many different areas, many different types of investments, many different sectors, right? Finance, technology, and so on. I mentioned that stocks can be traded anytime within that 9:30 AM to 4 PM Eastern time frame. Mutual funds, however, they take the ending price, that 4 PM close. Whatever the value is for those shares that are in that mutual fund, that portfolio, that's what is given to, let's say, the investor, right? That's the amount for the day. They don't trade multiple times throughout the day. It's just that at the closing time. With the mutual fund, again, you can be invested actively, as I mentioned, which is you have an account manager essentially managing the money, managing the accounts, the mutual fund, the whole portfolio, trading, selling, buying, different parts of the world, different sectors, and so on. They have a certain guideline they have to stick to, but they can trade essentially within that guideline, right? Now, that being said, on the passive side, it would typically be in index funds. The mutual fund would be buying index funds. What index funds are is they match a certain sector, they match a certain exchange, right? Toronto Stock Exchange, S&P 500, NASDAQ, so on and so forth. So instead of having it actively managed, it's going to be cheaper for you because it's passive. You don't have somebody who needs to be paid for managing it. And that is just going to mirror whatever that other thing does. Let's say you have an index fund that's mirroring the S&P 500. That index fund is going to try and do every single thing, all the returns, all the losses that the S&P 500 does. It's going to try to own every single company that's on the S&P 500 so that they can get the exact same return. So with the index funds, right, the passive side of it, again, you buy them in mutual funds. So again, it's only traded at the closing value, whatever that is, 4 p.m. close. That's the trading value for the day. It doesn't trade multiple times throughout the day. There is another passive investment that people can get, investors can get, and it's an ETF, an exchange traded fund. Now you can trade multiple times throughout the day, and it is also passive. Now you can purchase ETFs through, again, your stock account, your trading account, with whichever stockbroker you go with, because it is seen as a share and you do need to get it through them. And so you don't put it inside of your mutual fund. It's separate from a mutual fund because an ETF is like a stock or a share where it trades multiple times throughout the day. It's not just once at closing. You can trade multiple times throughout the day with an ETF. And again, you can put commodities in there. You can put different shares in there. It's pretty vast, the opportunities you have with an ETF. About the different types of shares, there's preferred shares and then there's common shares. You don't really need to worry about the two different types too much, but preferred, you don't really have voting rights. You do not have voting rights. It seems more like a bond where you're guaranteed a certain dividend payout over time, of course. But again, you don't have voting rights. But common shares, you do have voting rights. And of course, you still get your dividends and so on and so forth. But you do have voting rights. Now, when you're buying and selling shares and stocks on the market, it's typically common shares that you're dealing with. So beyond that, don't worry too much about the two different types. So let's break it down and give you a quick review. A stock, you buy an individual share of a company at partial ownership. Mutual fund, you buy a pool of funds, right? You buy many different companies at one time, geographically maybe, different sectors, and so on. ETFs, you buy a basket of securities like stocks, bonds, and so on the stock exchange, right? It's traded on the stock exchange. They can be in many different sectors. They can be in many different geographic areas. Index funds can be bought inside of your mutual fund, passive, not actively managed like a mutual fund, like most funds rather in a mutual fund. And an index, again, it typically matches or attempts to mirror something specific like an exchange, S&P 500, NASDAQ, whatever it may be. So lastly, segregated funds, which I didn't mention, it's like a mutual fund, but it has a life jacket on, is what some people would say. So it has certain guarantees around it. It's offered through a life insurance company, but it's an investment, again, that operates like a mutual fund, but you have certain guarantees. You have a death benefit guarantee, you have a maturity guarantee, right? Death benefit guarantee, either 75% or 100% of the money that you contributed to it, which you can reset, by the way. If you reset it in 1 year, then that is the minimum value, that 75 or 100% guarantee. That's the minimum value that your beneficiaries are guaranteed. Same thing on the maturity benefit guarantee. After a certain amount of years, you're guaranteed either that 75 or 100% of your money. If something were to happen, if the market's down after that time frame, after the X amount of years, then you're going to be guaranteed whatever that amount was that you were guaranteed. But if you put in 50,000 and it goes up to 100,000 and you have a 100% guarantee, if you reset it that year before your maturity date, you're now guaranteed that $100,000 at maturity, or the market value, whichever one's higher. Some other benefits, it's private. No one knows that the money's in there except for you and the beneficiary if something happens to you. It can avoid the estate process if set up correctly, and I want to clarify that, if set up correctly. One other benefit I'll tell you is the creditor protection. Again, if it's set up correctly, I want to clarify that. And let's say somebody files for bankruptcy, this money is protected, or there's a lawsuit or something along those lines. If it's set up correctly, this money inside of the segregated fund is protected. And this type of account is offered through a life insurance company. So that's it for me, everybody. Hopefully that was insightful. Hopefully that was helpful for someone. Kadeem here. Stay happy, stay healthy, and stay blessed.